Gold didn't just slip. It fell hard enough to force a rethink of what stable even means. 3% and briefly cracked below $4,600 an ounce before snapping back toward $4,260. 5% in the same wave. That kind of drop is what people call unthinkable right up until it happens. Because gold is supposed to be the slow, heavy anchor of the macro world. It's not supposed to behave like a trap door. The time compression is the giveaway. Not quarters, not weeks. In roughly 48 hours, the market went from crowded confidence to urgent liquidation. And the most dangerous thing about a move like this is how quickly the public explanation becomes the official one. A stronger dollar, a hawkish Fed, a sudden mood shift. Those are the easy stories, because they fit in a single sentence and let everyone move on. But here's the part. Most people miss. Markets don't crash on opinions alone. They crash when constraints tighten. They crash when the plumbing changes, when collateral becomes scarce, when the cost of leverage jumps, and when risk systems force the same decision at the same time. That is the difference between a pullback and a cascade. There is also an information gap in moments like this. Institutions are not watching the same inputs most viewers are watching. While headlines argue about narratives, large desks monitor margin schedules, position limits, volatility triggers, and the mechanics of who is forced to sell if price keeps moving. They understand that the first domino is often not the story everyone debates, but the rule that quietly changes the math. What I'm about to walk through isn't a theory. It's a pattern, and it shows up again and again whenever a crowded trade meets a sudden tightening of the rules. If you've only heard gold fell because the dollar rose, you've been handed the ending without the plot. Welcome to Macro Signal, where we decode what matters before it becomes a recycled headline. The goal here is simple. Follow the data, follow the mechanics, and follow the institutional incentives that actually move price. If you like analysis that stays calm, specific, and grounded in numbers, you're in the right place. And if this is your first time here, drop a comment with where you're watching from, because the community is the best signal filter we have. Now let's reconstruct what happened, step by step, like a forensic report rather than a rumor. The visible catalyst was a shift in U.S. policy expectations after news that Kevin Warsh was nominated to lead the Federal Reserve. Markets didn't need a full policy roadmap to react. They only needed to infer a direction. The reaction was straightforward. Price in a more hawkish posture, more comfort with tighter financial conditions, and less tolerance for inflation sticking around. That inference pushed the dollar higher, and when the dollar strengthens quickly, it tightens conditions across the commodity complex. On a normal week, that could have meant a choppy decline, but this wasn't a normal week because the second catalyst wasn't a narrative, it was a rule change. As volatility surged, the CME raised margin requirements on gold futures. Initial margin moved from 6% of notional value to 8%. Those look like small numbers until you translate them into behavior. Futures are inherently leveraged. You control a large notional exposure with a smaller capital outlay. When margin rises, every leveraged participant gets a bill. It is due immediately. And it is due at the worst possible moment when the price is falling and the position's equity is already shrinking. Here's where it gets concrete. One standard COMEX gold futures contract represents 100 troy ounces. At $4,650 an ounce, the contract represents about $465,000 of notional exposure. At a 6% margin, the required collateral is about $2,700 to $900. At 8%, it's about $3,700. That's a $9,300 increase per contract overnight just to keep the same exposure. Multiply that by 50 contracts, and you're wiring roughly $465,000 more collateral. $86 million in additional cash requirement, on top of whatever the price move just did to your equity. That's not a philosophy debate. That's cash management under stress. And here's the real trigger hiding in plain sight. Margin hikes don't change anyone's long-term view on gold, but they instantly change who is allowed to hold gold today. They are procyclical by design. They rise after volatility rises, which means they demand more cash exactly when portfolios are already bleeding. That forces liquidation from the most leveraged accounts first, regardless of conviction. It also compresses liquidity because market makers widen spreads when their own risk limits get hit. So the price drop becomes self-reinforcing. Falling price increases volatility. Rising volatility increases margin. Higher margin forces more selling. That loop is mechanical, and it overwhelms narratives in real time. That's why this move looked sudden and why the rebound can mislead. This is how a decline becomes a cascade. Price falls, equity shrinks, margin requirements rise, and the participant has to add collateral or reduce exposure. If they can't or won't add collateral, they sell. Their selling pushes price lower, which increases margin pressure across the system. That triggers more selling. The loop feeds itself. You can see the vulnerability in positioning, 8,000 previously. That tells you the market had begun to unwind even before the shock. In calmer conditions, an unwind can be orderly. In a margin shock environment, the same unwind can become disorderly because the timeline is no longer dictated by preference. It's dictated by collateral deadlines. And here's the contradiction that sets up the rest of the story. Even as price collapsed, a major long-term support for gold remained intact. Central banks, the slowest and most deliberate buyers in the system, continued to accumulate. In 2025, central banks bought about 863 tons net, and the National Bank of Poland was the largest disclosed buyer, adding roughly 102 tons. That is not the behavior of a world that suddenly decided gold is obsolete. It is the behavior of institutions that treat gold as balance sheet insurance rather than a short-term trade. So how can an asset be accumulated by official balance sheets and still plunge violently? Because in the short run, price is often set by the most leveraged and most time-sensitive participants, not the most patient ones. The market can be structurally supported and mechanically fragile at the same time. That sounds like a contradiction, but it's actually the definition of a dislocation. To see why, you have to zoom out and recognize the historical pattern that keeps repeating. In 1980, gold surged into a blow-off top after a decade dominated by inflation fears and geopolitical stress. The rally was real. The reasons were real. But by the time the peak arrived, the trade had become crowded. When conditions shifted, the exit narrowed and the move down was brutal. The world didn't suddenly become peaceful overnight. What changed was positioning and the cost of carrying the trade. The result was a reversal that punished late entrants and taught an old lesson. Safe can be volatile when everyone crowds into the same door. In 1999, another kind of lesson appeared. Gold wasn't in a mania then, it was in neglect. The policy environment and official sector decisions mattered more than daily headlines, and shifts in confidence about central bank sales and leasing created sudden moves that surprised people, precisely because they assumed the gold market was too slow to react. The pattern was different in direction, but identical in principle. When the institutional framework changes, the price can move faster than the public expects. In 2011, the structure returned in a modern costume. After the global financial crisis, gold became the emblem of distrust in fiat money and institutional stability. The rally made sense, but as it climbed, it also became a consensus. When real rates began to rise and the dollar affirmed, gold didn't gently drift. It dropped, and the following years were defined by a slow, grinding hangover. It was that the price of that hedge had become inflated by leverage and crowding. In 2013, the market offered another reminder. Gold broke sharply after years of post-crisis support, and the move wasn't about one single data release. It was about a crowded positioning structure, meeting a sudden shift in the willingness to hold. Once paper selling started, liquidity thinned, stops triggered, and the decline fed on itself. The exact story at the time was debated endlessly, but the pattern was familiar. A crowded trade, a volatility spike, and a rapid unwind that looked fundamental only after the fact. In every case, the trigger people remember is the headline. The mechanism that actually amplifies the move is leverage meeting a constraint. When volatility rises, when margin rules tighten, when risk systems enforce the same reduction, the market stops trading on beliefs and starts trading on survival. Now look at the current setup. The recent rally in gold wasn't just a defensive allocation story, it also became a momentum story. That matters because hedges are held through discomfort, while momentum trades are flipped at the first sign of a regime change. When an asset becomes both, it inherits the fragility of momentum. It can be loved for the long term and sold violently in the short term, because different participants have different time horizons and different constraints. That's why the real trigger is not just the nomination headline. The nomination shifted expectations. The margin action tightened the system. One changes opinions, the other changes behavior. Now let's talk about the institutional movement, because the cast explains the choreography. Start with the exchange. CME doesn't raise margins to punish anyone. It raises margins to protect the clearing system when volatility rises. The exchange's priority is that trades clear and that the system can absorb losses without cascading failures. From their perspective, higher margin is a safety buffer. But from the market's perspective, it is a sudden increase in the cost of carrying positions. It is a forced decision point. Then consider the leveraged funds. Commodity trading advisors, macro hedge funds, and systematic trend followers often run exposure with tight volatility targets. Many of them are not sitting around debating whether gold is a good hedge. Their models look at volatility, drawdowns, and correlation. When volatility spikes, they cut. When drawdowns deepen, they cut more. When margin rises, they cut again because capital efficiency worsens. And because many participants use similar risk frameworks, they end up acting in the same direction inside the same window. Add in option flows and dealer hedging. When markets swing, the hedging needs of options books can change rapidly, and that hedging can amplify directional moves, particularly when liquidity thins. The point isn't to claim one hidden hand is pushing a button. The point is that the system contains multiple feedback mechanisms that can align. When they align, price moves faster than the narrative can update. Now add the financing layer. Prime brokers and banks don't like surprises, and they don't like tail risk. When markets swing, they adjust haircuts, scrutinize collateral, and enforce margin calls quickly. It's not because they have an opinion on gold, it's because they have an obligation to manage counterparty risk. A margin hike at the exchange level can ripple into tighter internal risk constraints at the broker level, which can accelerate de-risking even further. Meanwhile, there are the long horizon buyers. Central banks and reserve managers aren't trading around headlines. Their purchases are slow, sometimes opaque, and often disclosed with a lag. They don't typically step in to absorb a leveraged cascade in real time because they are not positioned as liquidity providers. They are allocators. Their presence can matter for the stabilization and rebound phase, but it does not prevent the flush phase. This is how you get the appearance of coordination without needing a conspiracy. The timing aligns because the system responds to the same volatility and risk signals. The sequence is mechanical. Price swings increase measured risk, exchanges raise margins, brokers tighten, funds de-risk, and liquidity thins. The market moves not because everyone agreed, but because everyone faced the same constraints. Now we reach the dislocation, the part where two different truths coexist. Truth number one is the paper price. Futures markets are deep and fast. They allow massive exposure to be adjusted quickly. That's useful most of the time. But when many participants try to reduce exposure simultaneously, the futures market can push the price far below what slower moving physical demand would justify in that moment. Paper flows can overwhelm everything else because claims on gold can be sold in volumes that dwarf immediate physical turnover. Truth number two is structural demand. Central bank buying at 863 tons net in 2025 is structural. It is not a day trade. It reflects diversification choices, reserve strategy, and a preference for an asset that is no one else's liability. That demand doesn't vanish because a chart prints a bad candle. It persists through cycles. When those two truths collide, you get an apparent paradox. Gold is being accumulated by some institutions while being liquidated by others. That paradox is resolved when you remember that the selling pressure often comes from the need to raise cash and reduce leverage, not from a change in long-term conviction. This is the part no one is discussing. When a market is forced to sell paper claims quickly, the price can temporarily decouple from the slower channels of physical allocation. Dealers can widen spreads. Liquidity providers step back. The cost of immediacy rises. And that's exactly when the chart looks like a breakdown, even if longer horizon demand remains. This is why you sometimes see a strange split in the conversation. One group looks at the chart and says demand must have vanished. Another group looks at the bigger context and says demand may still be there, but it is not the marginal price setter during a liquidation. The marginal price setter in a flush is whoever has to act under a deadline. That deadline is created by risk limits, margin calls, and volatility targets. It's between time horizons. Silver's behavior reinforces that point. 5% drop in silver is the signature of de-risking. Silver is thinner, more volatile, and more sensitive to leverage and liquidity. When silver gets hit alongside gold, it often means the market is not carefully repricing a story. It is clearing positions. It is doing balance sheet triage. Now put the evidence together as a chain. 3% and dips below $4,600. Volatility spikes. 8% for heightened risk accounts. Leveraged participants face larger collateral demands at the same time their positions are losing. They reduce exposure. That selling pressure pushes prices lower. The decline forces more risk reduction. Meanwhile, long horizon demand exists in the background, but it operates on a different clock. This is why the move feels like it came out of nowhere. It didn't. The vulnerability was there in the crowding and the leverage. The trigger was the tightening of the rules. Now, let's make the mechanism crystal clear, because once you understand it, you'll recognize it the next time it appears in a different market. Think of leverage like carrying a heavy object across a bridge. The bridge can hold you as long as the load limit stays the same. Margin is the posted load limit. When the posted limit is lowered, you have to lighten the load immediately. You don't get to argue that your destination is important. The sign is the sign. If you can't lighten the load, you have to turn around. In futures, lightening the load means selling contracts. If many participants are forced to lighten simultaneously, the selling becomes concentrated. Liquidity thins, and each sale moves the market more. That causes more losses for remaining holders, and more of them are forced to lighten. The loop is tight. This is also where the normal explanations start to fail. A stronger dollar can pressure gold, but it doesn't automatically create a sudden air pocket. Air pockets are usually about market structure, about who has to sell right now. When the market is calm, fundamental narratives dominate. When the market is stressed, funding and risk dominate. The market turns from a debate into a margin call. This is why viewers often feel blindsided. The public watches the last step, the price drop, and then looks for a story to explain it. Institutions watch the first step, the constraint tightening, and prepare for the selling that must follow. It's not magic, it's procedure. So what does the data suggest from here without pretending to offer certainty? Historically, a margin-driven liquidation tends to lead into one of three paths. The conservative path is stabilization. Once the forced selling completes, volatility contracts, the daily range shrinks, and price begins to move in smaller increments. In that environment, you often see volume normalize and the market stop reacting violently to every incremental headline. The clue is calm returning to the tape, not necessarily an immediate rally. The moderate path is a rebound that retraces part of the drop. When leverage is flushed, the marginal seller disappears. That creates room for opportunistic buyers and long horizon allocators to step in. If structural demand remains intact, price can recover because the market no longer has a constant stream of forced sellers. The rebound, when it happens, tends to be slower than the drop because fear exits quickly and confidence rebuilds slowly. The aggressive path is broader contagion. If the liquidation in metals is part of a wider de-risking across macro portfolios, then gold can continue to be sold simply because it is liquid. In stressed conditions, funds sell what they can, not what they want. In that scenario, the signals to watch are not metaphysical. They are mechanical. Funding stress, cross-asset volatility, and signs that collateral is being hoarded. Also, watch the next round of positioning data. 4,000, it's telling you a large portion of leverage has already been reduced. If that number continues to compress while price stabilizes, it often suggests the market is clearing without attracting aggressive new short exposure. If the number rebuilds quickly while volatility stays elevated, it suggests the crowd is re-entering before the system has calmed, which is when repeat shocks become more likely. If this pattern continues, the indicators worth monitoring are straightforward. Watch whether margin policy changes again. Watch whether open interest shrinks as price falls, which often indicates long liquidation rather than new aggressive shorting. Watch the dollar's pace, not just its direction, because the speed of tightening matters. Watch real rates, because opportunity cost narratives are powerful when they move quickly. And watch for ongoing evidence that official sector accumulation remains persistent, because that is the slow bid that can matter after the fast money leaves. Now we get to the divide, the part that determines who learns from this episode and who simply reacts to it. There are always two ways to read a violent move. The first reading focuses on emotion and narrative. The second focuses on structure and flow. It's not about intelligence, it's about attention. The largest advantage in markets is often the ability to separate long-term demand from short-term forced selling. Institutions move first because their systems force them to respond to risk and collateral. Retail tends to move last because retail is watching the story get translated into a headline. By the time the headline feels obvious, the forced flow is often already completed. Gold's hard slide is a reminder that safe does not mean stable on short timelines. Safety is a long horizon attribute. Stability is a condition that can break when leverage meets rule changes. The market didn't invalidate gold's role overnight. It exposed how quickly the paper layer can unwind when the cost of carrying exposure rises. This is macro signal, where we decode what matters before its headlines. If this connected dots you hadn't been linking, you know what to do. Because the question isn't whether markets will keep testing assumptions. The question is whether the mechanism will be visible before the next test arrives.